Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now.
Travis, you ready for me to get things going here with Upstart?
Yeah, I want to frame this. Just give me the 20-second overview on what are we looking for? What are the metrics in an Upstart earnings report that you're looking at to see is the business doing well or not?
So a starting point, what is Upstart? So Upstart is not a lender. They are a lending platform where loans get originated. Now, they have originated loans that they've kept on their balance sheet to sell after the fact, but generally the bulk of their loans that get originated are done with a lending partner, a bank or a credit union, or a consumer finance company that is a lender, right? So that's what their business is. The hook, the mousetrap, they're saying that their better mousetrap is they've used AI, and we've got some former Googlers that have built the company that point out that this reality that there are a lot of people that are kind of left on the outside looking in with the modern credit system, the way that it's built. And they think that there are a tremendous number of credit worthy people that the current FICO system deems as unworthy in terms of the level of credit risk. And they're saying they have a better product. So that's kind of where we're starting from there, Travis.
That's the thesis. Yep.
That's the thesis, right? And here's what we don't know. We don't know if that's completely true. We have seen some evidence that the loan performance from some of the partners that are giving us the data has been good, but we haven't really seen it through a full economic cycle. Okay. And this is really, really important because the core business, the loans that are originated on the platform right now, the bulk of them are unsecured consumer loans. In other words, you have credit card debt that you want to consolidate or a student loan, and you want to consolidate that debt and try and get a lower interest payment. It's a consumer loan that you get. Here's the thing, Travis. It's not, there's not an asset that backs it. There's no collateral.
There's nothing to seize. There's no house. There's no car.
Right. So what that means is that this is the kind of debt that is at the leading edge of the risk when defaults start to happen when we go into like a weak economy. We actually go into true recession, right? So the challenge with understanding Upstart at this point is since the company was born, we haven't had an economic downturn, like a full recession. Again, we went through the pandemic, right? But there was a massive amount of government aid that flowed in, and people had plenty of money, and a lot of people still have money coming out of that. So we haven't gone through a normal,
went up, which is really unusual during
a
recession.
Totally, yeah. So we haven't gone through like a normal, recession where we're going to find out about the performance of its loans and whether the product that they've built and the AI that looks at these other metrics is right, and whether those loans are going to perform better. We're not going to find that out now. So you're starting to pull up some of the numbers there, Travis, and I'll go through it and I'll hit it. And here's the thing. We expected a lot of this. Revenue down 31% in the third quarter. Fees-based revenue down 15%. Again, we expected that, right? We've already seen on November 1st, the company filed an SEC filing that they had fired 140 employees. Travis, those employees process loan applications, right? Yeah. So you're terminating revenue building employee, people that actually handle the thing that drives your revenue, right? So it's not a surprise. We also know that a lot of their lending partners have kind of pulled back from the platform a little bit. Banks are getting really risk averse right now. So we knew that was going to happen. So now here's some big things that are important. The big thing is that, again, as we started to see in the prior quarter, shifting to a loss, operating loss of $58 million,
yep,
down from an operating profit of almost $29 million a year ago. GAAP net loss, $56 million, again, from a profitable year-over-year period. I'm gonna slide down a little bit further. I'm going to skip the outlook, and we're going to come back up to that. And what I wanted to look at is I want to talk about statement of cash flows. Okay.
We'll
get down to that. And that is on page 5 and 6. It's kind of cut in half.
There we go.
So if we go down to page 6, you'll see net cash provided by operating activities. So here's the thing. The left is last year, the right is this year. And you see, this is the big thing, right? Because there's that net loss, and then there's how much cash you burned to support your operations, and burned through $421 million, right? So that's substantial, right? So that's really important. I want to go back up to the balance sheet next, because when you're burning through cash, you kind of need to know how much cash, how many assets do you have to get you through this. So cash and restricted cash, you're looking at around 800 million, right? So that number is starting to come down. Now, one thing that you see that has ballooned is loans held at fair value, right? That's $700 million. That's a big $500 million increase. We've already seen the market freak out in the past when the company ended the quarter with a large amount of loans on its book. Again, that's not the company's core business. They don't want to become a lender, right? Because that changes all the rules. The regulatory regime is very different. So they don't want to be primarily in the lending business, right? They want to be the platform where loans get originated. They make money on fees and services, and then somebody else takes it off, and then they go make money on the interest, and then they take on the risk of the loan defaulting, right? So it's going to be interesting to hear what management says about that very large number. And how the market reacts to it. Here's the risk of that number, okay? Travis, this is, I think, is really, really important. If the company doesn't already have an agreement in place with a lending partner to acquire those loans, and it could, and they're just going to carry over the quarter, and they're going to be acquired, and some are going to come off the books, after the quarter ended. And again, management's going to give us some information about that on the earnings call. But here's the risk, Travis. If their loans do not perform, and it has to hold loans longer than it wants to, and the loans and the performance of those loans deteriorate more than the company has projected that they would, and all of the data that they provided to the market and to their customers and potential customers, the value of those loans is going to take a hit, right?
Yep.
So that's a risk, right? The other thing too is, frankly, if we just do go into a deeper recession than expected, that alone, even if the loans perform reasonably well, could affect the value of the loans, particularly if interest rates keep moving higher, right? Because every time interest rates move higher, existing debt that was originated in a lower interest rate regime is less valuable, right? So there are a lot of pressures that could affect the value of all of the assets they have, besides cash, obviously. But that particular asset, we don't know what it's actually going to be worth to the company. And at the rate that it's burning through cash, again, $420 million in cash burn just in this past quarter. So I think that's a really, really important thing to think about with Upstart. Is you can exit the screen share here, Travis.
Yeah.
The way I'm thinking about Upstart right now is this is kind of its crucible moment. It's about to go through the crucible and prove out whether it's a high quality metal and we're going to get something amazing after it gets, born in fire, or is it going to burn up, right? And there's a little bit more to it too, because it doesn't control a lot of its future, because it does rely on a pretty concentrated group of lending partners for the bulk of the loans that get originated. There's the risk that it's just its fixed costs versus the revenues that it's bringing in. It's just going to burn through a ton of capital before we get clear of this. And that could be very detrimental to shareholders. So I think it's an interesting risk reward investment for investors that two things. Number one, can risk capital. They can get incinerated and they can move on with their lives, and it doesn't affect their lives at all. It's okay. They can actually lose that money. Number one. And number two, investors that can deal with the volatility of what could happen over the next year or two with the company.
So many questions with this company. That's what I think I really have a hard time wrapping my head around. And I'm familiar enough with the banking business and how loans work to be dangerous, but this isn't my specialty. But you get to a company like this and it just seems so volatile. And like you said, we haven't been through a down cycle. I mean, this is sort of the wild thing, is that right now through, let's say, middle of next year, maybe into next year, is going to be probably the first real normal recession that a lot of these big name public companies who became public since, let's say, 2010 have ever been through.
Right.
And not to mention, not only that, the recession piece of it, but it's the first time that any of those companies have been in a rising interest rate environment.
Yeah. So you think about a company like this, right, with their cash burn, living off their balance sheet, and they got they generated a tremendous amount of profit for about a year there. And then everything that's happened, and the lenders have gotten very risk averse. So no, you're exactly right. So we're seeing in real time, that's what's happening with Upstart. I want to point out a couple of positives real quick, Travis.
Okay.
They continue to add banks and credit unions to their platform. Okay. They've more than doubled it. A year ago, they had like 35 or so. Now they've got 83. So that's really, really good. The problem is, again, look at the loan volume, look at their revenue. Look at the fact that they cut loose 140 people whose jobs are to process. And it's not like they said, oh, we've come up with a new AI tool that we don't need these people to do it anymore. It's the macroeconomic condition. We have to reduce staffing. We have to make this move, right? So there's a little bit of positive, but there's the reality that the banks they're tightening their belts and they're being really careful right now. I really have a lot of hope in what Upstart's doing. One little thing that they mentioned in their presentation is they start to give a little bit of data about things like looking at demographics and the fact that they do originate more loans to minorities, right? As an example of evidence that, hey, our process, our risk identification process is better, right? I'm hopeful that that's the truth, but we're not. Now, this is when we're going to start finding out.
Yeah, that's a lot of questions ahead. So thanks for that recap. I just don't know. I put this one in the too hard bucket. I'm going to keep watching it. I'm going to keep listening to people like you talking about it because I think it is a really interesting space. But I'm just not smart enough or confident enough to know that this is going to be one that's going to go crazy over the next few years, because it does seem like you are playing a risk reward game. $1.5 billion market cap. They've got to hit a home run to survive this. So any final thoughts there before we move on?
Yeah, there's nothing wrong with waiting sometimes. Just wait and watch and let the market. And here's the bottom line with Upstart, right? You don't have to get a perfect price on it. If it does have a revolutionary disruptive product and you wait and buy 2 years from now when it has data to back that up, this can still be a massive winner for investors. You don't have to buy at the height of the risk, which could be right now.
Yeah, you don't have to hit the bottom. You can wait until they've proven out that they can be a profitable business and wait till the risk part of the risk reward balance is lower.
Yeah.